Welcome to Summit Talks. I'm Sean McDermott. Today we're going to talk about how income taxes work and how to proactively reduce what you pay now and into retirement. Here's what we'll cover. First, we'll look at the basic federal tax formula. Then we'll look at how deductions work. And after that, we'll look at the tax brackets for ordinary income and for capital gains. And most importantly, we'll give you some practical tax mapping strategies with the retirement case study at the end. So what is a tax? A tax is your share of income that funds public services. So for example, if you earn $10,000 and there's a 10% tax, you owe $1,000 to that government agency. Taxes are collected at different levels of government. There can be federal, state, and local agency taxes, such as sales and property taxes. The basic formula is to start with a total income, subtract your deductions to arrive at taxable income. Then apply the tax rates. First, let's identify what's included in your sources of income. Here's a snapshot of page 1 of the Federal 1040 form. As you can see, lines 1 through 8 capture wages, investment income, retirement income, Social Security income, and more. All this feeds into your adjusted gross income on line 11 and then eventually your tax bill. After we add up your income sources, then we can subtract our deductions. There are two types of deductions which are most commonly used. We have the standard deduction, or we can itemize our deductions. You can deduct a standard amount or itemized deduction if they add up to be higher than your standard deduction. So the standard deduction for a single person is $16,100, and for married couples, it's $32,200. Now, if you're over age 65 or blind, you'll receive an additional $2,050 for single or $1,650 for each married couple. The new Big Beautiful tax bill passed in 2025 added a temporary senior deduction for people over age 65, which is an additional $6,000. You'll notice on the right side of the screen, there is some phase out for these deductions for higher income taxpayers. Now, adding all this up for people over age 65, for singles, the standard deduction is $24,150, and for married filing joint, $47,500. This is quite a bit of write-off against your ordinary income. So, summing it all up, you want to try to find out what's going to be a greater amount, the standard deduction or itemized deduction. Here are some of the more common itemized deductions. You can add up your property taxes and your state income tax paid up to $40,400. This is higher than last year when the SALT cap was at $10,000. Additionally, you can deduct mortgage interest debt on mortgages up to $750,000. You can subtract charitable contributions and donations. You can also add up medical expenses, and if they exceed 7.5% of your adjusted gross income, then you can write them off. With the Big Beautiful tax bill, there's also no tax on tips and overtime, and no tax on car loan interest if the car is manufactured here in the United States. Here's what page 2 of the Federal Tax 1040 form looks like. In section 12, you would subtract off your standard or your itemized deduction, whichever is higher. Line 15 is the most important line item to understand because your investment income decisions hinge on what bracket the income is taxed. So if you're keeping notes, please take a look at your line 15 of your tax return. Now we can go onto the two tax brackets to find out how much you owe. We're going to talk about two different sets of tax brackets where you would be multiplying your taxable income by your tax rate. First, we have the ordinary income tax rates bracket, and then we also have the capital gains and qualified dividend tax bracket, which is a lower, more favorable bracket that you want to be in. Here's the ordinary income tax brackets for a single taxpayer. You can see that there's a 10% tax rate on taxable income between $0 and $12,400. Income over $12,400 then goes into the 12% bracket all the way up to $50,400. Then the next marginal rate is 22% for incomes between $50,401 and $105,700. The higher your income, the higher your tax rate is going to be. And this is what we call a progressive tax system here in the United States. Let's take a look at the married filing jointly tax rates. So the 10% bracket is up to $24,800 of income. Anything between $24,801 and $100,800 is taxed at 12%. And above that, it goes into the 22% bracket. and higher all the way to 37%. One point I'd like to illustrate here is that the first portion of your income is going to be taxed at the lower rate of 10%, and then the next portion at 12%, and any income above the thresholds will be taxed at the next tax rate. So you don't pay a flat 22% tax on all of your income. This is a very important concept called your marginal tax rate. It's the tax bracket your last dollar fell into. So this is a key concept that we want everyone to understand because it's the first thing we want to think about when we're trying to decide what source to draw income from at retirement. It's also important to know how to invest prior to retirement on a pre-tax or after-tax basis. For example, when you're retired, it's ideal to stay in the lower brackets. You want to carefully consider where you're drawing income from, whether it's coming out of your IRA or possibly other after-tax sources, so you don't push yourself into a higher bracket. If you're not retired and investing in things like your 401k, you could either be putting money away pre-tax or after-tax Roth. Again, I would look at this from the perspective of what makes the best sense for your marginal tax rate. And this, again, will drive the decision on how we want to invest in the future or take income in the future. Moving on from here, we have another set of brackets that are more favorable for capital gains and qualified dividends, which get a different tax treatment. The public policy goal is to have a lower tax rate to encourage investing in businesses, stocks, and real estate. The brackets are very similar to where they are in the marginal brackets, but they are much lower rates. Here's the capital gain tax rate schedule for married filing jointly couple. The single brackets are about half of what you see here. You can have up to $98,900 and pay zero taxes. The next portion between $98,901 and $613,000 is only taxed at a 15% rate, and then it goes to a 20% rate. So obviously these are very favorable. One of our tax planning goals is that we want to proactively allocate our portfolios so we can have more qualified dividends at capital gain income at these low rates. I'll show you this in an example coming up here. So to sum it up, there are two distinct types of income brackets that you'll use to calculate how much taxes are owed. After you figure out how much taxes are owed, then you can start looking at your tax credits. The tax credits are dollar for dollar offset against your tax bill. So some of the more common tax credits are healthcare, earned income, savers, and energy tax credits. So that's the bottom line of it. You figure out what you owe, you subtract your tax credits, and then you will know how much you have to pay in or how much you get back this year. Let's wrap this all up with a case example of John and Grace. So John was offered age 60 early retirement from his career at a national bank, and his wife Grace worked for the school district and decided to retire at the same time, age 60 with John. They needed to decide where to draw income from during the retirement and had many different sources, including pension and Social Security benefits, 401k, employee stock ownership plan, employee stock purchase plan through his bank. He also had a large 401k balance, and he's very concerned about future required minimum distributions at age 73. So one of their objectives was to consider Roth IRA conversions where they would pay tax now, and the retirement account would compound tax-free for future withdrawals. Their preference was to delay the pensions and Social Security because the longer they delayed, the higher the income benefit would be for their lifetime. Their goal is to find a tax-efficient plan for their income by running different tax mapping scenarios. So I'd like to illustrate these scenarios for you, but before I do that, let's break their investments down into 4 different tax buckets. We have the taxable bucket where you pay as you go, and this could be from interest on bonds and bank accounts. We have the tax deferred bucket, which is from sources like 401ks and IRAs where everything stays deferred until we decide to take the money out. And we have the tax-free bucket, which could be from municipal bonds and Roth IRAs. And then we also have a tax advantage bucket, which could be from specialty investments like real estate and stocks or stock funds. A key planning goal is to allocate income across these buckets to maximize tax efficiency. Favor the lower tax sources when possible and use tax advantage accounts strategically. I'm next going to show you 3 different scenarios and calculations that we use for John and Grace in order to have the lowest tax possible early in retirement. And I'm using a tax software package called Tax Clarity, which I find is a quick and easy way to find tax savings and illustrate results. In this first example here, we're looking at John and Grace taking their bank stock and selling it early in their retirement and realizing long-term capital gains. So they had around $500,000 of bank stock, and their original investment in it was $250,000. So that would be their basis in the stock. And then the gain part is $250,000 on the $500,000 of stock that they own. So early in retirement, first year of retirement, what we recommended that they do is that they go ahead and sell half of their stock, and they realized a $130,000 capital gain. This capital gain by itself, there's zero tax, zero federal tax due that year because of their standard deduction. And remember those charts that I showed you earlier, the capital gain tax rate is 0% all the way up into the 90-some thousand. So first 2 years of retirement, one of their goals was to start doing Roth IRA conversions so they wouldn't have so much money built up in the pre-tax tax deferred plans and have to take out a lot of money at age 73 from required minimum distributions. So they opted to do a Roth conversion. A Roth conversion is where you voluntarily pay tax on your retirement account now in whatever bracket you're in. And then once it's in the Roth IRA, it compounds tax-free for life. There's no minimum required distributions at age 73, and it goes tax-free to your heirs. So what we wanted to do with these Roth conversions, we said, okay, let's take $130,000 and convert that. So you notice here in this white area, this is going to be their standard deduction, no tax there. This next step here, that's the 10% bracket, so very low federal tax. And then here's the 12% tax rate bracket. And so we're keeping all of this $130,000 conversion in the 12% bracket for a total tax of $11,136 of federal tax. And the effective rate is around 8%. So very little income tax due on this Roth IRA conversion. Now, for a couple years into retirement, they did Roth conversions. And then John and Grace's goal was to draw their Social Security and pensions at age 65. Their Social Security is going to be $60,000 a year or $5,000 per month. And pensions are $3,000 per month or $36,000 per year for a total of $96,000 per year of income. So that's $8,000 a month. Their total federal tax is $1,235, only $100 per month. That's a pretty low effective tax rate. And kind of summing this up, John and Grace in the first 5 years of their retirement paid very little income tax on their assets. Now, I think we accomplished a lot of their goals where they did the following. John rolled over his 401k to an IRA and proceeded to do Roth IRA conversions in the lower tax brackets. They took their employer stock and used the long-term capital gain tax rate brackets at 0% very effectively the first few years of their retirement. And they both decided to defer their Social Security and pensions to age 65. And at that point in time, the tax rate was very low. So that's our case example for today. Thanks for watching the Summit Talks video. Visit our website for free downloadables. We have a book called Summit to Retirement, and consider scheduling a free of charge, no obligation tax mapping session. If you found this helpful, please subscribe to our channel for more insights.